In Quantitative Trading, how to build your own algorithmic trading business. Ernest Chan shows how an individual trader with limited capital and modest technology can still build a serious algorithmic trading operation. Instead of relying on complex mathematics, the book emphasizes straightforward but disciplined principles. How to generate trading ideas, test them rigorously on data, automate execution, and manage risk like a professional money manager. In this video, we'll walk through the core mindset and key lessons of the book in a concise, easy-to-apply format. Quantitative Trading: How to Build Your Own Algorithmic Trading Business by Ernest Chan is a practical, down-to-earth manual for turning algorithmic trading from a vague dream into a concrete, small-scale business you can run yourself, instead of dazzling the reader with heavy mathematics or opaque hedge fund jargon. Chan focuses on simple but rigorous principles: how to come up with ideas, test them properly on data, build systems that actually trade, and manage money and risk in a disciplined way. The book is written explicitly for independent traders with limited capital and computing power, not for large institutions. Chan starts by defining what quantitative trading really means. At its core, it is trading based on explicit rules that can be programmed and then tested on historical data. The rules can be drawn from technical analysis, fundamental data, or even news and text information, as long as you can encode them in numbers and logic. A quantitative trader does not eyeball charts and decide based on gut feel. Instead, he or she specifies exact conditions under which an asset is bought or sold, and then lets a computer execute them. This is often called algorithmic trading, and in modern markets it accounts for a large portion of trading volume. Crucially, Chan demystifies the idea that you need a PhD in physics or advanced financial engineering to play this game. His own background is highly technical, but he explains that, for the kind of statistical arbitrage he focuses on mainly in stocks, futures, and sometimes currencies, you only need high school to undergraduate level statistics, the ability to compute averages, standard deviations, correlations, simple linear regressions. Proficiency with Excel and, ideally, a mathematical platform like MATLAB or its cheaper open-source equivalents is enough to build and test useful strategies. The message is that accessibility is much higher than many people think. The true edge is not in having the fanciest model, but in execution discipline and risk control. From there, the book moves to idea generation. Chan argues that there is no shortage of trading ideas in the public domain. Academic finance papers, trading books, blogs, online forums, and financial news columns are full of proposed strategies, factor models, seasonal patterns, and technical rules. In fact, he provides a non-exhaustive list of sources he personally uses: business school working papers, finance journals, major newspapers and magazines, and a number of well-known trading websites and forums. The real challenge is not inventing a completely new idea, but deciding which ideas are worth your time and how to refine them into something that fits your personality and constraints. To do that, Chan recommends first taking a hard look at yourself. How many hours a day can you realistically devote to trading and research? If you work full-time in another job and only have mornings or evenings free, then you probably should not start with strategies that require minute-by-minute monitoring or intraday execution. Instead, you might focus on daily or weekly rebalancing systems that can be prepared before the market opens or after it closes. Next, what is your programming skill level? If you are comfortable in languages like Python, MATLAB, or C#, you can manage more complex portfolios and possibly intraday strategies. If you are limited to Excel and basic scripting, it may be wiser to begin with a simpler universe and lower frequency. Capital is another key constraint. With small accounts, leverage is limited in retail brokerage. So Chan discusses using instruments with natural leverage like futures or FX. Or, for some traders, joining proprietary firms that grant much higher buying power in exchange for revenue sharing. Larger accounts unlock more data sets in markets such as high-quality survivorship bias, free stock databases, intraday feeds, and fundamental data, but also force you to think early about capacity, how much capital a strategy can absorb before its edge erodes. Even once you know what you can realistically handle. Not every idea taken from a paper or forum deserves a deep, time-consuming backtest. Chan suggests a quick screening phase where you apply a set of sanity checks. The first is simple: compare the claimed or preliminary performance to a reasonable benchmark. For a long-only stock strategy, benchmark might be a market index such as the S&P 500. If the strategy's long-term return is not meaningfully better, you might be better off just buying an index fund. For long, short, or dollar-neutral strategies whose overall market exposure is low, the benchmark becomes the risk-free rate, such as short-term treasury yields. Next, he focuses on Sharpe ratio, which measures average excess return per unit of volatility. A strategy with high average returns but extremely volatile P&L may not be practical. As a rule of thumb, Chan notes that strategies with Sharpe ratios below 1 are usually not suitable as standalone systems. Strategies with Sharpe around to generate profits in most months. Those with Sharpe above 3 often make money in most days and are very valuable, though also very rare. He pairs this with an examination of drawdowns, how deep the worst equity peak to trough loss is, and how long recovery takes. Even if the numbers are mathematically acceptable, you must honestly ask whether you could stomach a 20 to 30% loss over several months without panicking and abandoning the system. Another early filter is how sensitive the proposed edge is likely to be to transaction costs. A strategy that trades very frequently with only tiny edge per trade can disappear entirely when realistic commissions and bid-ask spreads are included. Chan gives examples where a mean reverting system on futures looks excellent before costs and becomes sharply negative after subtracting even a single basis point per side. He also warns about survivorship bias. Many cheaper value strategies look far better in databases that omit stocks that later went bankrupt or were delisted. A sound strategy should either use bias-free data or be robust enough that the effect of bias is limited. Chan repeatedly emphasizes that simplicity is a virtue. Models with many rules and parameters are more prone to fitting random noise in historical data, a phenomenon known as data snooping bias or overfitting. He recounts his own experience in large institutions. Highly sophisticated models built by PhDs often produced beautiful backtests but disappointing real-world performance. In contrast, simple strategies that any smart high school student could implement have sometimes performed better once put live. His mantra, borrowed from Einstein, is make everything as simple as possible, but not simpler. Once a candidate idea passes the screening phase, the work shifts to rigorous backtesting and devotes significant attention to the mechanics of backtesting because, in his view, most failures in live trading can be traced to mistakes or overconfidence at this stage. He compares common platforms. Excel is very visual and intuitive. And for basic rules, it helps you avoid certain errors like look-ahead bias, since it is easy to see which row and column correspond to which date. MATLAB and similar environments provide far more power when dealing with large universes, statistical routines, and text processing such as scraping web pages for data, but demand more programming discipline. The first requirement of any backtest is clean data. Historical prices must be correctly adjusted for stock splits and dividends. Otherwise, you may misinterpret mechanical price jumps as meaningful signals. High and low prices can be tricky because they often reflect very small trades, execution on obscure venues, or even bad ticks. Using them too aggressively for limit order logic can artificially inflate performance. Survivorship bias in data is another recurring theme. A long-only strategy tested on only currently listed stocks will systematically understate risk and overstate returns because it ignores names that failed. For performance measurement, Chan recommends focusing less on absolute return and more on risk-adjusted metrics. Sharpe ratio is his default tool, measured on an annualized basis. He explains some subtle points such as when to subtract the risk-free rate and how to annualize based on the frequency of returns. He also describes how to calculate maximum drawdown and drawdown duration from the equity curve or cumulative return series. These drawdown metrics, though simple, are crucial because they capture the worst cases you might have to live through. Then come the traps. Look-ahead bias occurs when your backtest inadvertently uses information that would not have been available at the time of trading. Examples include using the full day's high-low to decide an intraday entry, or calibrating model parameters using the entire history and then pretending they were known in earlier periods. To defend against this, Chan advises consistently lagging signals, using only information up to the prior close to make orders, and performing structural checks, where you truncate the last part of the historical data and verify that the earlier signal history remains unchanged. Data snooping bias is more insidious. Anytime you test many parameter combinations or add rules to improve the backtest on a fixed historical sample, you risk discovering patterns that are mere accidents. Chan suggests several remedies. One is ensuring that your sample size is large relative to the number of free parameters. You need enough independent observations to justify optimization. Others out of sample testing, where you split history into a training set to design and tune the model and a test set to evaluate its untouched performance. A further step is using rolling windows where parameters are continuously re-estimated on the most recent data, mimicking how the model would adapt in real time. Finally, sensitivity analysis, a systematic check of how performance degrades when parameters are slightly changed or rules are simplified, helps you identify setups that are only narrowly profitable in specific configurations. Because the book is about building a business, Chan spends a full chapter on structure and infrastructure. He contrasts two main paths. In a standard retail brokerage account, you deposit your own capital, trade under your own name or entity, enjoy regulatory protections like SIPC insurance, and pay retail commissions. Your leverage, however, is limited by regulations, typically twice your equity for overnight positions and 4 times intraday. In a proprietary trading firm, you contribute some capital but primarily trade the firm's capital. In return, you usually get higher leverage, lower direct costs, institutional-grade tools, and sometimes training. The trade-off is that you are subject to the firm's rules, risk policies, and revenue share, and your account is not necessarily protected in the same way as a retail one. There is also the risk that your strategy could be observed and imitated internally. Chan's advice is to evaluate potential brokers and firms on several dimensions beyond headline commission rates. Execution quality and access to liquidity are paramount. Better routing, smart order execution, and dark pool access can save far more money in slippage and price improvement than a small difference in commission. For a quantitative trader, API support and a good paper trading environment are essential. Without them, you cannot properly automate and test your systems. Product range matters as well. If your strategies span stocks, futures, currencies, you need a platform that can handle all. He also encourages trading across more than one venue when possible, both for diversification and for comparing real-world performance across infrastructures. On the physical side, he shows that initial requirements are modest. A reliable PC, a stable broadband connection, and a basic, uninterruptible power supply are enough to start. Over time, as strategies and capital grow, you might invest in more monitors, faster machines, better connectivity, and possibly remote hosted servers or co-located machines near exchange matching engines to reduce round-trip latency. Even then, Chan insists that unnecessary complexity in infrastructure can be just as dangerous as unnecessary complexity in models. Every additional piece raises the chance of operational failure. The transition from backtest to live trading happens through execution systems. Chan distinguishes between semi-automated systems, which still rely on some human action, like checking a spreadsheet and pressing a button, and fully automated systems that run end-to-end without manual intervention during the trading day. Semi-automated workflows often involve downloading historical data once a day, running a script in Excel or MATLAB to calculate positions, saving the resulting orders to a file, and then loading that file into a broker's basket trading interface. For certain strategies, you can use spreadsheet links to pull real-time quotes and trigger macros that send orders via the broker's interface. This approach can be perfectly adequate for daily rebalanced or small universe systems. For more time-sensitive strategies, intraday mean reversion, or high-frequency approaches, full automation is essentially mandatory. Here, you write software that directly connects to the broker's API, subscribes to data streams, computes signals in real time, and sends orders programmatically. Languages like Java, C#, and C++ are common because of performance and API support. Though the exact choice depends on the broker's offerings, Chan notes that, unfortunately, few broker APIs plug directly into environments like MATLAB, so you often need a separate execution layer, even if your research is done in higher-level tools. No matter how slick your code is, Chan strongly advocates a paper trading phase before risking real money. Running your system in a simulated environment that closely mirrors live conditions exposes bugs, timing issues, and operational flaws that a backtest cannot reveal. By comparing the paper trade list and P&L to what your backtest suggests should have happened for that period, you gain confidence that the logic and data alignment are correct. Paper trading also gives you a feel for the day-to-day operational burden. How long data updates take each morning, how often connectivity or data issues arise, and how much time you must spend monitoring the system. Even with all of this care, live performance can deviate from backtest expectations. Chan walks through typical reasons: higher real-world transaction costs, partial or missed fills, latency and slippage, and especially changes in market structure or rules. He cites examples like the decimalization of stock quotes and the removal of the uptick rule on short selling, which fundamentally changed the microstructure and affected many statistical arbitrage strategies. The lesson is that no backtest, however careful, can permanently validate a model. Ongoing monitoring and reevaluation are necessary. In the chapter on money and risk management, Chan introduces the Kelly criterion as a theoretical framework for optimal capital allocation and leverage. Under simplified assumptions, returns are Gaussian, and you know the true mean and variance. Kelly formula tells you how large your bets should be to maximize the long-term logarithmic growth of your capital. In a multi-strategy context, you can estimate the mean returns and covariance matrix across strategies and invert that matrix to derive an optimal allocation vector. While mathematically elegant, Chan is quick to point out its limitations. Real-world return distributions are not Gaussian. Parameter estimates are noisy, and extreme tail events, the famous black swans, occur more often than the model allows. Because of these realities, he recommends fractional Kelly, typically half or less of the calculated optimum. This sacrifices a small amount of theoretical growth in exchange for much lower risk of large drawdowns or outright ruin. One of the key insights he emphasizes is that risk directly reduces compound growth, even when average returns are the same. Two strategies with identical mean returns but different volatilities can have very different long-run outcomes. If you bet too aggressively and suffer deep drawdowns, the mathematics of compounding work against you. It takes a much higher percentage gain to recover a large percentage loss. Risk management, in his view, is not just about position sizing, but about how you respond to the evolution of performance. A sensible, Kelly-based system naturally reduces exposure when returns deteriorate and increases it when returns improve, assuming your estimates are updated in a rolling window. This stands in contrast to discretionary behaviors such as doubling down after losses or locking in a fixed leverage ratio regardless of conditions. Good risk management also contemplates model risk, the possibility that your strategy is fundamentally wrong or has stopped working due to competition or structural shifts, software risk, where bugs or misconfigurations cause unintended trades, and operational risk, where power, network, or hardware failures prevent you from managing your positions. In each case, appropriate safeguards, monitoring, and fallback procedures are needed. Despite all the focus on algorithms, Chan devotes a section to psychological preparedness. He argues that a major advantage of quantitative trading is that it removes emotion from day-to-day decision-making. But this only works if the trader resists the urge to override the system at critical moments. Behavioral finance has identified biases such as loss aversion, where the pain of losses outweighs the joy of equivalent gains, causing traders to cling to losing positions and cut winners short. There is also the endowment effect, where people irrationally value what they already hold more than equivalent alternatives, and various forms of overreaction to recent performance. Chan observes that many traders, himself included at times, have altered models or shut down strategies after a handful of bad trades, even when backtests and theoretical considerations suggested such drawdowns were inevitable. He also discusses the twin temptations of despair and greed. In despair, after a period of poor performance, traders may slash position sizes or abandon a strategy entirely just before it recovers. In greed, after a streak of success, they may aggressively increase leverage, exposing themselves to a catastrophic loss when conditions change. His pragmatic advice is to start with modest position sizes, gradually scale them as you gain confidence in both the system and your own emotional reactions, and adhere to the risk framework even when it feels uncomfortable. Experience, in his telling, is as much about learning your own psychology as it is about refining models. A later chapter presents a tour of advanced topics commonly encountered in quantitative trading. Chan elaborates on the distinction between mean reversion and momentum strategies. Mean reversion assumes that prices or spreads will tend to revert towards some equilibrium level after deviating. Momentum assumes trends persist for some time before reversing. Markets can exhibit both behaviors at different timescales or in different regimes, and strategies must be built accordingly. He notes that mean reversion strategies can be particularly vulnerable to data errors and biases, since anything that falsely exaggerates price extremes will make them look more profitable in backtest than in reality. For momentum, he points to drivers such as the gradual diffusion of news, where it takes time for all investors to process and trade on information, and the execution of large institutional orders, which can push prices in the same direction over hours or days as the order is sliced. Behavioral herding traders following what they perceive others to be doing is another force that can create trends. However, increasing competition and faster information processing tend to compress the time window during which simple momentum rules work. Under the umbrella of regime switching, he acknowledges that markets seem to shift between periods of different volatility, correlation, and trend characteristics. Academics have proposed Markov switching models and hidden Markov approaches to formalize this idea. But practical implementation has challenges. Transition probabilities between regimes are hard to estimate, and simply assuming they are constant over time, as many models do, misses the very events traders care about. Chan mentions data-driven approaches where a large number of potential predictors, like volatility, returns in other assets. Macro data, sentiment indicators are considered in a machine learning model to identify likely turning points. Even here, he warns that the usual dangers of overfitting and false discovery remain. A more concrete and widely used concept in the book is stationarity and cointegration. Many individual price series, like stocks or commodities, behave roughly like random walks and are not stationary. They wander away from their starting points. However, certain combinations of them, such as the spread between two economically related assets, can be stationary, fluctuating around a long-term mean. If you can identify a pair or portfolio where a linear combination of prices is mean reverting, you have the basis for a pair trading strategy. Buy the underpriced side and sell the overpriced side when the spread is extreme, then unwind when it reverts. Chan shows that cointegration is about these long-run equilibrium relationships and is different from correlation. Two assets can be highly correlated in daily returns, but not cointegrated, or cointegrated but not strongly correlated at high frequency. Chan also introduces factor models, such as the Fama-French three-factor model, which explains stock returns in terms of exposure to systematic factors like market beta, size small versus large capitalization, and value high versus low book-to-price ratio, in a factor framework. Each stock's return is decomposed into a part explained by its factor exposures and a residual specific return. If factor returns are reasonably stable through time, you can design strategies that go long stocks with desirable exposure profiles and short those with less desirable ones, or simply use factors to understand and hedge your risk. The book points out, however, that factor performance can shift. For example, value factors may underperform for long stretches, and the market's preference for growth versus value, or for certain sectors, can change abruptly. Factor-based strategies can therefore experience painful drawdowns when their underlying risk premia temporarily invert. Another practical design dimension is the exit strategy. Chan stresses that entry logic alone is not enough. How and when you exit positions is critical to realized performance and risk. Two common methods are fixed holding periods, holding a position for a predetermined number of days, regardless of interim developments, and target prices or profit caps, where trades are unwound when a certain price or P&L threshold is hit. In momentum strategies, it can also make sense to exit when the model's entry signal flips sign, effectively turning an entry in the opposite direction into an exit for the current trade. For mean reversion strategies, he suggests using statistical estimates like the half-life of reversion to guide expected holding periods and exit thresholds. Simple stop-loss rules can be counterproductive in pure mean reversion systems, since they often force exits near maximum deviation just before prices snap back. He illustrates seasonal trading strategies as a special case of systematic patterns. Equity markets show calendar effects like the January effect, where certain categories of stocks outperform in January. Though he notes that many such effects have weakened over recent years, commodity futures often have stronger and more persistent seasonal patterns tied to physical demand cycles, such as heating and driving seasons. These can be exploited by rules like buying a specific contract at a specific date each year and exiting at a later date. Still, because seasonal trades usually generate only one or a few signals per year, sample sizes are small and caution about overfitting is warranted. High-frequency trading HFT is treated as an aspirational but challenging domain. Chan argues that high-frequency strategies can achieve very high Sharpe ratios because they place many small bets. By the law of large numbers, if each bet has a small positive expectation and limited variance, aggregated daily returns can become quite smooth. However, HFT demands tick-level data, extremely fast and robust technology, and sophisticated execution. An independent trader, it is not the obvious starting point, though elements of intraday mean reversion and short-term strategies can be approached at a lower level of sophistication. Towards the end of this tour, Chan raises the question of whether it is better to pursue high leverage on low beta portfolios or to invest in high beta portfolios without leverage if you want to increase returns. He points to research suggesting that low beta portfolios often have higher Sharpe ratios than high beta ones. By applying moderate leverage to low beta high Sharpe strategies within sensible risk limits, you can achieve better long-term compounded returns than by simply buying volatile high beta assets. This connects back to his earlier discussion of leverage and the Kelly framework. How you scale risk matters just as much as where you deploy it. In his concluding chapter, Chan tackles the big question explicitly. Can independent traders really succeed in quantitative trading? His answer is cautiously optimistic. He points out that large hedge funds and banks face severe constraints. They must deploy huge sums of capital, subject to regulatory and internal limits, under constant performance pressure from investors. To move the needle, they need strategies with large capacity that often forces them into slower, lower Sharpe trades and temptations to over-leverage. Their models can end up highly correlated with one another, leading to episodes of quant meltdowns where many funds suffer the same losses simultaneously. Independent traders, by contrast, can profit from small inefficiencies and niche strategies that are meaningless at institutional scale, but significant for a smaller account. They also have the freedom to ignore organizational politics and complex mandates, focusing solely on building simple, robust systems that make money. Chan envisions a realistic growth path. Start small with one or a few well-tested strategies. Treat trading as a business by tracking metrics and improving processes. Reinvest profits into better data, more powerful tools, and new strategies, and carefully scale capital according to risk principles, rather than greed. If you eventually reach a point where your personal capital and strategy capacity justify it, you may consider taking outside money or joining a fund on favorable terms, armed with a solid, verifiable track record. Throughout his central message is that there are no secret formulas or shortcuts. The edge lies in doing the basics extremely well, keeping models simple, respecting the limitations of data, testing carefully, controlling risk relentlessly, and managing your own behavior as rigorously as you manage your code. Thank you for listening, and I hope this book proves truly helpful on your trading journey.